I'd like to thank everyone for joining today. I'll just give it a minute for everyone to get their technology settled. So I think I'll go ahead and get started. Today we're covering a look back at what occurred in markets last year and a look ahead to what we're thinking about for 2022. We won't be taking any live questions today, but if you do have questions, please feel free to reach out to myself or your financial planner, and we can answer your questions. I'll put my contact information up just on the final screen of the presentation, so you have it if you need it. I think many of you know me from over the years, but in case you're newer to the center or we haven't met, I'm Angela Palacios, a partner and director of investments here at the center. I've been with the center for going on 14 years now, and prior to being with the center, my total time in the career has spanned over 20 years. One of my primary responsibilities is to chair the firm's investment committee and lead the research process, where we discuss a variety of topics like that impact your portfolios. I'd like to start with a recap of 2021 with some of the topics that our investment committee was focused on, and then move into our outlook for 2022. So let's get started. The year 2021 saw this transition from a vaccine-fueled and policy-led recovery to a more fundamentally driven expansion. And amid this backdrop, there were supply chain disruptions, meme mania, and historic S&P 500 records. You can see that bonds had a slower year as rates started to increase in the second half of the year, impacting bond returns. And they were down about 1.5%, while US large cap and developed international markets had a great year, both up double-digit percentage points for the year. The S&P 500 again was really the star, as it has been for many of the last 10 years. So in the stream of so many headlines, constantly, I like to take a look back at the year, at the mini market, macro and market events that may be hard to recall at this point in time. So let's look at some of the highlights quarter to quarter from last year. So we had a very rocky start to the year with Capitol protests or riots, the swearing in of President Biden. The American Rescue Plan was quickly put into place, allowing $1,400 checks to arrive to qualifying people at the end of quarter 1 last year. We had meme stock mania, which I mentioned earlier. I don't know if you remember hearing about GameStop, where social media was used to bring attention to the stock. Then we transitioned into the spring, where we started to see inflation start to accelerate. We had lumber prices skyrocket just in time to impact home building for the spring and summer, as well as home improvements. Vaccines became widely available, and we saw record job openings. People were really willing to start venturing out and spending their money again last year. This meant companies that had cut back on employees were now scrambling to hire. As summer wore on, we started seeing the Delta variant surge throughout the country, and there were fears of shutdowns again. China had its own real estate crisis, if you remember hearing about Evergrande debt issues. And lastly, at the end of 2021, we had the Federal Reserve begin tapering its bond purchases. The Omicron variant surfaced, which was more contagious, but we weren't really sure of the severity yet of that variant. And of course, then inflation hit record levels of 6.8% right at the end of the year. So it was quite a year throughout 2021. And it's hard to believe with all those headlines, the S&P 500 was up almost 30% last year. So throughout 2021, Economies continued the reopening trend despite variants of COVID. There was building evidence that economies are finding ways to mitigate the shutdowns caused by the virus, partially due to vaccines and immunities built naturally, but also a fatigue of the restrictions. You can see with the chart on the left-hand side over here, you can see that there's a downward sloping line showing that there were fewer lockdowns throughout the year. One risk to this trend, is if the virus becomes more severe and starts to evade vaccines, that could serve as a headwind to the economy. As you can see, there are upticks in that kind of shutdown index as we get new variants or waves of the virus. But when you look at 2021, overall that trend was downward and fewer lockdowns. Energy also is a big indicator of reopening and kind of a big winner throughout the year last year because people became mobile again, traveling and going back to work. The chart on the right shows demand by quarter of oil. And you can see that we're nearly back to that pre-COVID demand for oil. If you look at like the darkest blue line, that's kind of the most recent reading that we have. The lighter gray lines are the projections going forward, that could potentially rise, demand back to those pre-COVID levels by the end of the year. According to Goldman Sachs. And I agree with those projections. I think we're going to continue to see that increase in demand there. So this chart is just a little different way of looking at the reopening. It gives you more of a relative comparison or baseline to where we were before. That's the dotted line that you see here across the top. So where we started before the virus. And then where we are now, you can see that the opening scale falls off a cliff. When the COVID shutdown originally started, we closed things and stayed home and didn't venture out. And then you could see it kind of slowly reopened, and then we had kind of some more waves of the variants. And you can kind of see that throughout 2021, really, this larger trend of reopening took over. You can see that developed markets are nearly back to fully open. And really, we're getting back to almost to this feeling of normality of where we were. Nothing in the past 2 years has been normal, whether when you think about the virus or the stimulus in the economy. It's really been this distorted kind of pandemic cycle that everyone has tried to make sense of. But I think this gives us a little bit of comfort in seeing that things are kind of getting back to normal as far as reopening. Another interesting note, about 2021 and even back into 2020 after the market recovery started in the early spring, we hadn't seen any meaningful market pullbacks. We get asked the question all the time, why do stock markets keep going up? And I think this chart does a great job of what was causing that feeling among investors. So up until the start of this year, we had gone a very long time without a 10% pullback in the S&P 500. The light blue bar is the time frame most recently that we hadn't experienced one, although that changed at the start of this year. March 2020 was the last time prior to this year that we had a 10% pullback. The green dash line is the average number of trading days that you see across your screen that markets go without a 10% pullback on average. And we were nearly double that length of time at the beginning of this year. It's important also to understand that even smaller pullbacks, like 5% pullbacks, happen even more frequently, usually 3 to 4 times a year. I know many people don't realize that. And we only had one of those last year that happened right at the end of the year. So you can see how we've gotten used to just very little downside volatility over the last year. You've probably heard me say before in these presentations that stocks really love climbing a wall of worry. I think this chart does a great job of putting that into a visual. These are major economic headline risks that we've experienced over time. By no means is this an exhaustive list, but it does hit some of the higher volatility inducing headlines over time. The dark blue line is, or the black line is the growth of the S&P 500 over the past century. And you can see that there are some major impacting events, yet over time markets grew, they were resilient. During all times, it's important to remember to keep your financial plan in perspective. As you can see over the years, there is always a reason to sell or to sit on the sidelines. But over time, markets have shown themselves to be very resilient. For those of you that work with Tim Wyman, you may have heard him say to you, it's important to remember that volatility is an expected outcome. We expect volatility and negative returns to happen from time to time in your financial plan. So it's normal to see 2 or 3 negative years over a 10-year period. What isn't normal is this run of kind of unanswered positive returns we've had. Don't get me wrong, we're all happy that they occurred, but we're always thinking ahead to, when it comes to developing a successful financial plan for you, anticipating that those periods of volatility are normal and will happen. I know you've heard us tell you that timing the market is not necessarily a good idea. So I love to find different ways of showing that to you. Selling stocks at the first sign of a market decline may make you feel better over the short term, but it can really cost your portfolio and your returns over the long term. Consistently predicting when those days will occur is close to impossible. So sticking to your plan and staying invested can help you make the most of them. Because as you can see, missing out on those up days can really limit your portfolio's long-term return potential. Missing just 30 of the best market days over a 20-year time period, so missing 30 days in 20 years, can turn a $10,000 investment into just $7,400. Whereas if you just held on, you would have had over $42,000 just by staying invested in the S&P 500 index over that 20-year period. So missing out on those 30 days can cost a lot of money. It's also important to note that the best days usually come right after, if not the very next day, after some of the worst down days in markets. So if you find it difficult to stomach these ups and downs that we're experiencing, it may be appropriate to make some modifications to your plan, but let your financial planner talk through that decision with you first. And let's make sure we're making the right decisions for the right reasons. I'd like to turn the conversation over to kind of this year and what we're seeing, and as well as talking about the Federal Reserve. That's been a major headline that we've seen lately. So I think it's important we touch on that. The Federal Reserve closely monitors 2 situations: the unemployment rate, which is very low again right now, and inflation. So now their focus is on inflation. You can really see on this slide that the Fed is expecting to start increasing interest rates here to start combating those inflation numbers that we're seeing. The dotted lines all the way on the right of your screen are the expectations that we're seeing priced into the overnight index of forward swap rates. And that's just a fancy way of saying interest rate expectations. Where do we think they're going and when? So you see the path is upward. They also anticipate, the Federal Reserve does, to stop the asset purchasing program that has been in place since the pandemic. And that's going to finish out in March of this year. The government shouldn't need to continue to issue as much debt at this point as the deficit in relation to GDP growth is slowing. So it's important to note that, tightening cycles don't necessarily mean the end of an economic expansion, nor the end of an equity bull market. From an economic perspective, rate hikes don't immediately hamper an expansion. As history shows, that the economy usually grows for about an additional 5 years on average following the first rate hike. Similarly, the equity bull market historically continues for several years. However, in the near term, expect the transition into this tightening cycle to lead to more muted returns and elevated volatility, which we're seeing right now, than we've grown used to. There's typically 3 to 4, 5% pullbacks in the market in the 12 months that follow that first rate hike. But again, this is normal, as we normally expect 3 to 4, 5% pullbacks in markets over a 12-month period, as I mentioned earlier. Another way to look at inflation is how much the outlook for rate increases has changed, from 6 months ago. If you look at the first bar, you can see that 6 months ago, no interest rates increases were factored into this March Fed meeting that's coming up. So that light blue number says 0.0 above March 22nd, 2022. And now the market is pricing in 1.4 rate hikes, and actually even a little bit more since this chart was generated. So you can see that there's just been a huge shift in expectations in the last 6 months for the bond markets. If you look through year end, 6 months ago, the market was pricing in only about 1 rate hike, and now it's pricing in over 5 rate hikes by that time. So this has posed some challenges in the bond portfolios over the past 6 months. We started to prepare portfolios really well over a year ago by increasing our allocation to shorter duration bonds. This isn't an area that we typically hold long-term in our portfolios, but rather we use it and deploy that opportunistically when rates are very low and we expect them to start to increase. They're much less sensitive to interest rate increases than intermediate or long duration bonds. And it has helped returns, in this negative bond market that we've seen versus just holding a bond index that has a very high duration. Another, again, thinking about what the Fed is focused on, they're focused on inflation. So let's talk a little bit more about that. This has unnerved many people because we aren't used to this. It's hitting our pockets directly with higher prices at the grocery store, higher prices at the gas pump. As I wrote about in our investment commentary last quarter, we have the basic ingredients present right now for higher inflation. Too much money chasing too few goods. Sports equipment is a great example. When gyms closed, we all wanted this interactive at-home exercise experience. A Peloton bike, for example, is a great example of that. All potential future demand for that bike got pulled forward at the onset of the pandemic, and many people wanted to order, resulting in huge backlogs in their order timeframes, being able to fill those. Didn't have to offer, sales or price incentives to sell their bikes. Well, because they ramped up their production to meet that much higher demand, they actually just recently announced that they're halting production because they have too much inventory built up and they need to, slow down their production of those goods to meet demand now at this time, or lack thereof. So their markets become saturated, and it's not a product that you have to buy frequently, So one way to get rid of this glut of inventory is to stop making an item, and you can lower your prices as well. So that's what we're seeing happening in the market right now with that particular focused area. I think cars are another great example. According to this chart here, used and new cars are making up a large amount of inflation outside of food and energy. If you look at this chart, this is really a representation of what's making up inflation, or at least that portion of inflation that's over kind of our core goods like food and energy. You can see that most recently, which is in this area here, the vast majority of this excess inflation over food and energy has been made up of used cars. You can see used cars are represented by the light blue, new cars are the dark blue, and that's been over 1% of inflation that is in just in the system right now. If we look at the remaining portions of that, furniture, sports equipment, these really are considered kind of the transitory areas of inflation when you hear that word being thrown around. It's so much of that is coming from areas that are maybe a little overinflated right now because there's supply chain disruptions, a lot of demand being pulled forward into today because people have a lot more money, and we'll talk about that in a minute. So we could anticipate really that a lot of these pressures become alleviated later this year as more inventory becomes available. The recent Canadian blockade, didn't help the car situation, but now that that's kind of over, we can look forward to hopefully, more cars becoming available and not such high inflationary pressures on that area. I'm not really calling for deflation, and that's not what this chart is getting at, but this portion over and above food and energy, while is adding to inflation right now, should start to detract from inflation going forward as we kind of work our way through this year, kind of wring out that excess money like sitting in bank accounts. Supply chain disruptions start to alleviate, and we can get more goods flowing into the market. We should start to see that pressure become actually the opposite, kind of a negation to our inflation numbers. We'll probably finish the year closer to that 4 to 5% inflation. That's what I'm thinking, but that remains to be seen. We'll have to see how the supply chain disruptions go throughout this year. So speaking of supply chain disruptions, I think it's important to spend a little time there just to show you what's happening. At the start of this year, the New York Federal Reserve actually launched the Global Supply Chain Index because it's been such an issue just to track trends over the last 25 years. This chart really highlights that the current level of supply chain pressure is far more acute than we've ever seen previously. Supply chain troubles have hit companies all over the world, particularly here in the US and in the Eurozone. Disruptions spiked back in early 2020, you can see, and then picked back up again over the course of 2021 as the economy reopened and people really started spending money. It really led to that surge in demand for all types of goods and services. Now, the higher the value in this index, the greater the disturbances in supply chains. So you can see that that's really kind of at an all-time high right now. One of the major kind of contributing factors to these supply chain disruptions is the processing of goods at ports alone. It's taking 3 times longer than normal right now to process shipping. This shipping bottleneck really is shown in this chart. And what that means is hundreds of ships have been stuck outside of major ports, unable just to unload the goods on the ship due to lack of truck drivers, warehouse congestion driven by lack of staff, but also just an increased flow of goods as we're buying more. We're shopping on Amazon, we're spending our money. According to this chart, as of January 6th, you can see all the way there on the right, there were over 105 ships waiting outside of LA and Long Beach, California alone, just waiting to unload the goods on the ships. These ports, those 2 ports together handle about 40% of the containerized imports into the US. And you can see that just a year ago at this time, there were only about 35 ships stuck waiting. So how do we dig ourselves out of this hole that we're in right now? I mean, there are several ways. People slow down their purchasing, stop buying as many goods that need to be shipped. So this will start to happen as people run out of those kind of extra savings accumulated throughout the pandemic that I touched on in a prior investment commentary. Another really is people going back to work, and as we're starting to see that more people working at these ports to help unload goods, driving the trucks, that'll help to alleviate some of this bottleneck. There are longer term programs like the US government has just kicked off to start training more truck drivers as young as 18 years old. None of these things are going to happen quickly though. So for now, the disruptions are here to stay for a little while, but I suspect a year from now, we probably won't be seeing these headlines as much as we are now. And I think we'll start to see this chart more in a downward trend line, hopefully. So let's talk a little bit about the consumer, since I've alluded to that quite a bit. Since the consumer is really a key part of alleviating these supply chain disruptions, I'd like to talk about us as a whole from some different aspects. With interest rates near zero and stimulus transfer payments from the government over the last 2 years, the consumer is strong, and that's what these charts are getting at. Going from left to right on this slide, you can see there are a record number of job openings. The gray bar that you see is this pre-COVID range of job openings in our economy, and this blue diamond floating above here is where we are now as far as job opening count. So we have way more jobs open than we've really ever had normally in the past. So anyone who wants a job right now can have a job. The consumer also has plans to spend money more so than now, as you can see by this second chart here on the slide, which makes sense because we have more cash on hand than ever, as shown here in this third chart. You can see cash balances normally for US households are in this range, but now they're kind of floating it way up here. Lots of cash in the bank. So we've seen some wage growth factoring into the health of the consumer as well, especially on the lower end of the range of income, as shown in that very last chart over on the right. So when you look at kind of all of these dynamics coupled together, the consumer is either above average or at record levels on every measurement there. And that's contributing significantly to inflation that we're seeing right now. So once we see those cash balances come back down to normal, we'll likely see spending plans come back down to normal, and thus that'll start flowing through into those the alleviation of those supply chain disruptions. Another good point is that we know the consumer makes up about 70% of GDP here in the US. So this should also serve as a good leading indicator that we're on pace for good GDP growth, at least for a while here in the US, meaning a recession in the near term is probably unlikely. So while we might see market volatility, it shouldn't be driven by the economy falling into a recession. So there's always risk that could push the economy over into a recession. And as an investment committee, we're always trying to look for factors that could signal a recession is on the horizon. The state of geopolitical affairs are always an item of discussion, kind of a wild card. And recently we've had a few that we've been paying attention to. North Korea nuclear buildup is a concerning one that was making headlines for a little while as they were doing some missile testing. Right now, the Biden administration is seeking direct diplomacy with North Korea, but they've really rebuffed talks and have escalated provocations. Recent studies have noted North Korea's nuclear production capacity is much larger than previously reported, making an increasingly serious situation there. We don't see an imminent threat of regional armed conflict, yet we do think tensions will continue to increase throughout 2022. We could see additional long-range missile testing by North Korea. We could see this, really, I think this might be a little underappreciated by markets right now. The pandemic has exposed, the supply chain vulnerabilities and really heightened our reliance on technology. Strategic competition between the US and China is driving this global fragmentation as both countries are really focused on reducing reliance on each other. The US Senate passed industrial policy legislation aimed at boosting the US competitiveness in critical technologies. The administration is pursuing these Buy American initiatives, and the SEC is increasing disclosure requirements for Chinese companies listing here in the US. So if you've been watching any of the Olympics, you can just hear the anti-China rhetoric from the commentators. It's pretty blatant right now. I know there are human rights issues adding on to this, but you can hear how strongly that we are trying to decouple ourselves from China. Russia, Ukraine finally are contributing right now a lot of volatility in headlines. Troops have been deployed, and the US and other countries are trying to impose sanctions on Russia, targeting Russia's energy and financial sectors in particular. The Biden administration reportedly has plans in place to assist allies with stepped up energy exports, should energy supplies be materially impacted. Overall, there's been a de-risking of Russia-linked assets in the market. An end result could be increased commodity prices and therefore even a little more inflation. And events like this, have the potential to cause short-term volatility in markets, but are usually short-lived, and repositioning portfolios usually isn't called for. As of the recording of this webinar on February 14th, there hasn't yet been a major military operation by Russia against the Ukraine, maybe partially due because the Olympics are going on, but this is looking more likely to happen. It's important, at these times to look at history, as situations often rhyme. So that's what we'll do on the next slide. But unfortunately, the worst market moving events, it's important to remember, are usually the ones we don't see coming, like the pandemic. As an investment committee and a society, no one saw the pandemic coming. But you might wonder why we don't often make major portfolio changes during these types of time periods, like right now with the Russia-Ukraine conflict. And I think this chart does a great job of explaining why. Stocks could be volatile for a while as headlines appear and people digest what these headlines mean, but the impact of stocks from geopolitical events historically has tended to be short-lived. Look at the average impact to markets over the variety of events we've experienced over time. On average, that yellow line on the bottom, when the headline surfaces, you might see about a 1% drawdown on the S&P 500, maybe in a single day. Total drawdown has averaged about 5% and takes about 22 days on average to occur. And then it usually takes about 47 days to recover. So usually these are very temporary bumps in the road. And some of these events might surprise you. I remember having an emergency investment committee meeting back in January 2020, where we determined that the outcome would likely be like many of the others, but it forced us to really look at the vulnerability of markets at that point. Ultimately, the changes we made in January 2020 were just rebalancing. If we had had some pretty positive market returns leading up until that point, So doing some trimming of equities and rebalancing. If anyone needed cash raised, we did that. If there were cash needs coming up over the next year, that determination ended up helping for reasons we didn't see coming, but it was an important kind of triggering moment to see, that markets were a little vulnerable at that point, and that it was probably, a good time to really proactively look at rebalancing. Something like the pandemic will never show up early on our radar, but those black swan events that no one sees coming are usually the most impactful to markets. Rebalancing and diversification are your best proactive moves to make to combat those black swan events. You can never get lazy when it comes to those aspects of investing, just never. Getting back to kind of these geopolitical events, though, these fall within the sphere of, again, expected outcomes in the financial planning process. We know that there will be some event making headlines always, every year, where we spend time in modeling scenarios and major course changes in the economy that could have lasting and meaningful impact on your financial plan. Those are things like inflation. We started thinking about inflation when it wasn't cool to think about inflation. We added an allocation to a real asset strategy, and people thought we were weird. I mean, we might have been early, but we weren't wrong. We might have made the change for different reasons than actually happened, but I love it when people think we're weird for doing something, because it usually means we're on the right track. I mentioned China a bit earlier, and I think it makes sense to take a little bit closer look at performance there. China, which represents a hefty portion of emerging market indexes, about 34%, has been hit hard by increased regulation and this rhetoric over what they call common prosperity. Their zero tolerance policies are really impacting their economy over there, very extreme policies around COVID-19. And we're seeing that in the Olympics as we're hearing of the frequent testing. In fact, China has underperformed the US by about 100% since the pandemic lows we saw in 2020. What's interesting is that many of the companies that are in the tech-related growth industries have significantly underperformed their US counterparts. China's starting to embark on their own easy money policies, just like we were 2 years ago. So this could be a potential tailwind for China versus the US, who is here in the US, we're starting to tighten our policies. We already have kind of a dedicated allocation to emerging markets in our portfolios, or possibly, international positions that are actively seeking exposure there for us. So this is something that we're trying to capitalize on in portfolios. So zooming out and looking at international markets as a whole, I like this chart because it shows just how long the US has outperformed international and by how much. US outperformance is shown by these gray areas, whereas the international outperformance is shown by the purple areas. And you can see the US has been dominant for quite some time since the Great Recession and has outperformed by almost 300%. So is it time for purple or international developed markets to shine? Do you think there could be a reversion to the mean or international markets playing catch up somehow? China easing monetary conditions has the potential to spill over into other emerging market countries pretty drastically as a positive force of growth. But most IFA areas, developed international areas, are staring at rising interest rates, just like we are here in the US. And another point, for international investments to start to perform better relative to the US is that certain sectors that tend to perform better as interest rates rise here as well as in Europe, for example, materials and financial companies do usually well during periods of rising interest rates, and international benchmarks are more heavily weighted in those areas than we are here in the US. So during a time when it's been difficult to maintain international holdings, we're doing so at full weight with this in mind. Proactive rebalancing when markets were quieter last year is really part of the plan of how we prepare your portfolio for volatility and plan ahead. This rebalancing occurred in much of the last half of the year as markets had pushed areas of the portfolio, mostly equity categories, overweight. We also monitor for losses during periods of heightened volatility like right now, so we can harvest them, try to offset gains that happen during better times. But we want to make sure that we aren't letting taxes dictate everything. We want to keep a balance, keeping you in the appropriate portfolio for your risk tolerance. We want to make sure that you have cash available on hand. If you have spending needs coming up, that's always an important one. We're shortening duration on our bond portfolios, or we did last year. That's an area I mentioned earlier, to try to combat those rising interest rates. And we've taken some credit risk off the table as spreads are very low between treasuries and high yield bonds right now. So you aren't getting paid very much to take on that additional risk. So those are some changes that we've made over the last year or so in portfolios. Planning ahead. Maintaining diversification isn't always easy when you see returns in the S&P 500 like we have year after year after year, but it is still a core tenet of our process. Proportional diversification between size of companies, global companies, it's all important to maintain. The above chart is a really great example. Over the past 23 years, a diversified portfolio, the black line, has beat an investment in just US equities or the S&P 500 over that time period up until just recently, actually. I think this might surprise you to see, but you can see why too. While diversified portfolios go down during bear markets, it goes down by less and takes less time to recover. If you look at two of the major bear markets from the past 20 years, you can really see this in action. During the 2000 drawdown, we had a diversified portfolio composed of the allocation you see down here, only down about 17.5%, and only took about eight months to get back to break even, whereas the S&P 500 was down 47%, taking 49 months to get back to break even. So I think that's a really kind of important consideration when you think about diversification. It may not happen or help every single year, but over time, it's going to help. Two of my mantras I have on a sticky note in my office and have for many years is really to stay even keeled and to avoid overthinking. These have helped me weather, much of the volatility throughout my more than 20 years of helping people with their financial plans. I think it's important to develop plans when we aren't worried or in the middle of a market downturn. The investment committee at the center took all last year developing and refreshing our game plans so that cooler heads always prevail when we're thinking about your investments. The financial planning work you do with us is of the utmost importance because this work lays the groundwork for how we need to think about your investments over time. So if you find yourself worried about returns, you might hear us asking some of these questions. Have your long-term needs changed? This is a good question because you likely aren't going to shift your retirement date or the date your child is going to college based on short-term market fluctuations. But it's always important to revisit those long-term goals that your money is working toward, just to make sure we're all thinking about things in the same way and correctly. What are your immediate needs for liquidity? Usually, if you're retired and you're taking money from the portfolio to live on, 6 to 12 months of withdrawals or needs set aside in cash can differ from person to person depending on needs and tolerances, but it alleviates the need to sell right when markets are at their worst. So that's something that's important to always be thinking about. This is something that we watch very closely for everyone and making sure that you have the appropriate amount of cash. Has your risk tolerance changed? Quite often you may think it has when we're in the middle of a market pullback. It's important at this time to really explore important questions like, are you able to sleep at night? Or if you're logging too many sleepless nights worrying, that's not a good thing. If you're having trouble sleeping, it may be a cue that you need to dial the risk in your portfolio back a little bit. On the other hand, if you look at those times as opportunities to add more money, you likely have a very healthy risk appetite for risk. This is something that may evolve and change over time. So we're always listening for clues and cues from our conversations with you to help us guide you in this path. Market downturns also offer opportunities for work to get done on your plan. It may prompt us to rebalance if your diversification starts deviating too much. We might be able to tax loss harvest, do broth conversions when assets are at depressed levels. So there are a variety of things that we're thinking about. So as we come to a close, I'd like to just give a quick recap of what we discussed. We reviewed 2021 and what influenced markets last year. We looked at current and potential future sources of volatility, inflation, interest rate movements, supply chain disruptions, the health of the consumer, geopolitical issues and opportunities, and what all this might mean for your portfolio. Our investment committee and department remain focused on proactive decision-making and rebalancing to try to make changes, whether it be during calmer or more volatile times in the market. We remain disciplined in our commitment to diversification, regardless of those volatile times. This is unchanged over the 35-year history of our firm. We've helped hundreds or probably well over 1,000 clients accumulate and plan for a variety of goals and life transitions like retirement, divorce, sending children to or grandchildren to college, and other significant lifetime financial situations through all different kinds of markets. We'll continue to be here for you. Thank you for listening today. And as promised, I will put my contact information up on the screen for you, and don't hesitate to reach out if any questions come to mind. Thank you.